Gentlemen, ladies and gentlemen, welcome. My name's Antony Abell. I've been invited by Chris today to come in and have a chat with you, excuse me, about what we're doing in blockchain and broadly speaking, blockchain and property. And so the headline stuff is we're working with the regulators, with the Bank of England, Bank of Canada, other regulators overseas, launching up to initial 20 regulated property exchanges across North America, Southeast Asia, and the United Kingdom. And we make property a liquid tradable asset class using these new technologies. So the model, to give you a headline, and I'm going to show you a few slides in a second, but the model on the headline is you can take a property in Singapore, run it through our verification, validation processes in Singapore, and use that to buy a cup of coffee in real time in sub 50 milliseconds in London. And that's the state of play of the technology today. And I stress that if you're aware of the marketplace and what's happening, automated market makers, if you look at the NFTs, non-fungible tokens, if you look at what's happening in this marketplace, which is trading in excess of 800 billion a month at the moment and increasing at about 1,200% on an annualized basis, you'll all of a sudden understand that some of these technologies I'm going to be talking about today are the baseline for a wholesale change in a lot of our financial and economic systems. And the work that we're doing with the Bank of England and with the Bank of Canada and with our FCA here in London is part of that process. We take a top-down approach to this marketplace. We're working with the institutions on an institutional grade product to create property that can be effectively used as money in the future. And part of the big shift we're seeing in the economy, before I go too far, is that we're moving to an asset-based economy away from a debt and fiat-based economy, and that the systems that we're talking about today are very much designed to enable that, and ultimately giving people more choices. We do see a world, and we have this already happening on our side of the fence here in our technology providers and with our suppliers, where our suppliers don't want to be paid in fiat, pounds, sterling, euros, dollars. They don't want to be paid in crypto, Bitcoin, Ethereum. They actually want to be paid in property certificates that we generate because they're inflation resistant. And our current modeling that we started with some 4 years ago, our current modeling indicates that monetary inflation is running north of 20, and in some places up to 65% a year. And on that basis, then money doesn't last long in its current form. And you have to have double-digit returns on that money to make sure you stay ahead of inflation. Otherwise, your money is melting like an ice cube on a hot summer's day. So that's my preamble. I hope I don't give you indigestion, by the way, with some of this stuff. We've done a lot of deep marketing, economics analysis. We've done modeling with the monetary policy units of some of the central banks on some of these pieces. This was 4 years ago. The COVID storm has accelerated everything. But it certainly will give you a topical conversation to talk about over the rest of lunch after I've left the call. Thankfully, I won't be there, so you can carry on without me. So let me get on with the show a little bit here. I'm going to show you a few things. I think you'll find them very interesting in terms of what we've got to, where we're going with all of this. All right, so TPX Property Exchange, our fundamental goal in life from 2016 is to make property a liquid tradable asset class on a global basis. And our target is to launch 20 exchanges over the next 18 months or so. The first exchange is in London. We have 3 set up with launch teams in USA, 3 cities in USA, 2 in Canada are earmarked. We have 1 city in Southeast Asia, and we're working on licenses for the subsequent cities. So hopefully you'll see us moving at pace over the next 8 months or so. Right, so I'm going to dive straight into this. I don't want to get too detailed on you. I don't want to give you too much indigestion before lunch. But fundamentally, what we're seeing is the fractional ownership of many things in the world. Not just property as we envision it, as a title of property, not share REIT, but title of property, the physical asset itself, which is a very key distinction here. You're seeing it with fractional ownership in shares. The Robinhood apps in the United States, eToro, these sort of things. We're not a great believer in some of those platforms because they're effectively selling order books to the broader, more established marketplace. But the desire, the appetite for fractional ownership of things, be those shares of Elon Musk's company, or be those shares of other things, somebody's baseball hat, shirt, card, films, all of these things are disintermediating the marketplace, and means that increasingly those who have things to sell the marketplace are going direct to the marketplace and bypassing a lot of the traditional channels. That has a lot of problems with it, of course. It's a new industry. It still needs regulatory aspects to it. It still needs policing. It still needs surveillance. But some of the fundamental pieces that are built, the blockchain, enables a degree of transparency and trust that, quite honestly, you can't find in an equity exchange. The processes that we're using on our exchanges gets rid of, if you're an equity trader, gets rid of slippage, gets rid of the selling of the order book in advance of the order taking place, which is common practice on many equity exchanges. There's no level 2 data on our exchanges. It's very, very clean, very, very transparent. And provided you get your on-ramps and off-ramps correct, i.e. you only have people who should be on the exchange trading on the exchange, and their identity is confirmed, and you have the ability to surveil and police the off-ramps, i.e. when they have an exit or realize a capital gain, then you have an inherently much cleaner and transparent system than has ever been possible before, and reduces and removes the bulk of the costs that usually is incorporated in running an exchange. So that's changing the world. So it's not just us. It's not just in property. We're seeing it in the so-called non-fungible token market, the NFT world. We're seeing it in equities. We're seeing it across the board. So these technologies are here to stay. A lot of people have taken a while to understand blockchain. From our perspective here at the cutting edge of what we're doing on a global basis, we're definitely cutting edge. We find it surprising that people still talk about the blockchain without it causing offense to anybody, because for us, the blockchain was 3 years ago. We've moved on. We're now into automated market makers and different technologies, which all are built on the blockchain. The blockchain is the essential building block upon which all these technologies are being built. If you look at where this world is going, again, we're looking at the financial apps, decentralized finance, which is part of what I was highlighting with the Robinhood type apps and the eToros. They're bypassing the market, they're bypassing the traditional channels, they're bypassing the costs and the processes that hitherto have been associated with that. And that's a fundamental change for the financial industries, because quite honestly, that's where they made their money. The death by 1,000 cuts and the process involved in listing a company onto an exchange, those are gone now from a lot of people from our perspective. The financial apps means that everybody with a mobile phone is the marketplace, not just the trader with a screen. The broker world is gone. Everybody's their own broker now. They're buying their own shares. Hyperinflation has also acted as an accelerant. They effectively put petrol on the fire for all of this. Hyperinflation that we're seeing right now, and those inflation figures, which I used to get your attention earlier, of 20 to 65, 60 to 65%, monetary inflation is very real, particularly in countries where they've become somewhat addicted to stimulus. We've seen the collapse of states, Venezuela, Lebanon. These things are increasingly going to happen as countries start to realize what's happening with the fiat debt-based economy. And increasingly, we're anticipating that people will move to an asset-based economy. And that's a fundamental theme of my conversation with you today. The sharing economy, we've seen a little bit before. Increasingly, for those who are watching history and the economic cycles that we go through, there is an enormous concentration of wealth occurring at the moment. Those who are in the asset-based economy, so to speak, are the ones who are doing best at the moment, because assets are largely speaking a hedge in inflation, high inflation periods, and those who've had the money are very aggressively buying assets around the world at the moment, be those productive assets or property of one form or another. In the traditional way, the wealth offices, the family offices, the pension funds are putting, and sometimes eye-watering amounts of money into property. We're obviously based on property in terms of what we're doing. We're seeing right now in Seattle and the West Coast of states, about 30% of properties being bought unseen, straight off the page on the same day that they list. Because such is the desperation for people to get their money out of fiat into any type of hard asset at all. that they're going straight in and buying it literally unseen without surveys. We're seeing that extending across other capital cities. In China, where their deflation of their currency is about 5% a month, anybody with wealth in China is desperate to get their money into the West and into any hard asset that they can get their hands on, which of course is driving different types of inflation in the property market in different sectors and different places, which I'm sure many in the audience there today would have seen. Here's a bit of a scary video. There's a fundamental social aspect to this. I mentioned this as part of the backdrop of what we're doing. I don't want to give you, again, indigestion, but it's worth noting because there is increasingly a world of have and have-nots, which the haves, of whatever shape, size, and description you might wish to describe them, they can't ignore for too long. And we're part of the process, we think, that addresses that by common ownership or access to common ownership without the social aspect to that. But it's worth watching this video and having a quick listen. Hopefully the sound comes through well. It's only about 20 seconds long.
How can you win? How can you win? You can't win. The game is fixed. So when they say, why do you burn down the community? Why do you burn down your own neighborhood? It's not ours. We don't own anything. We don't own anything.
Now that usually causes everyone a bit of an indigestion moment, so sorry about that. But it's well worth noting in the backdrop of what we're having and the concentration of wealth that's going on, which has happened over history many times, but ignore it at your peril. Unless you have a broader common ownership of the asset of your property, as you can see from that deck I just video I just sent you. The locals end up spray painting your walls or destroying the infrastructure because they don't own it, as she was saying quite rightly there. The end result is there are ways by which we can ensure that we can create the access to common ownership. It's not necessarily giving anyone anything for free. That has perils in history that doesn't work very well. But the key thing is to make sure that they have access. So our objective, as you can see with our one-click property deck there, is to ensure that people have access to it. If you have a mobile phone, you can buy a slice of title of property, the real thing, not a share of a REIT, not a share of a company that owns an asset, but actual physical asset under law. You can actually have direct access and ownership and legal ownership of it, and backed up by the law of the country in which it's issued. So we create that system so that anybody with a phone can buy property. If you want to buy it for £5, £10, 10p, that is possible because our technologies today allow us to do that. So I don't want to take too long a slide. If you can see here, the slides deck is going through. Very practical. For those women who like looking at property, this is the dating app of choice for property. You can now choose a property, swipe left, swipe right. For those who have ever experimented a little bit with Tinder, you're now in a position where you can date your favorite property. So you can choose which one you like. You can look at it. You can see its relativities. You can do the due diligence, all the information using the RICS Red Book here in the United Kingdom as a template for all of our exchanges. You can pick and choose which property you like most. You can look at its particulars, its search, its survey reports, its historic valuation, always a bête noire for any property deal. But you can now see a lot of information, and it allows anybody with a mobile phone anywhere in the world to purchase it. The lovely thing about assets, physical assets, title, and property is property in the deployment of all our exchanges. Property is not a regulated activity. We built all of our exchanges to be regulated, and we're working with the regulators, but they've expressly told us on a peer-to-peer platform, buying and sell property between individuals is not a regulated activity. It allows us to launch our exchanges globally very, very quickly. It also means that, again, we can go straight into the retail market. We have designed it with all the surveillance tools and systems and processes that a regulated investment exchange would require. And indeed, we have our applications for our IE license going through with the FCA, effectively starting in the next week or so. And we're on an expedited path with them because we've been working with the FCA on this since March of 17, slowly in the background. As you can see from the apps being demonstrated here, it allows people to very quickly choose the properties, manage their portfolio, exchange in whatever currency they wish. And in the payment rails that we've configured for our systems and in the interoperabilities that we've created with the fiat economy, that model that I highlighted with at the start of taking a property in Singapore and using it to buy a cup of coffee in London, we can deliver that in about 8 weeks' time, post the launch of the first London exchange. So we're there already in terms of the technologies. Going on, if you can see for the next slide, these are titles. They require trust, governance, transparency. The rule of the market still play. You have to have systems and processes and transparency for the assets to be trusted. There's aspects right now that putting it on the blockchain, everyone says, good, there it is in the blockchain, you can see it, but who's actually says it's real? And I can point to stories right now of this NFT market that's forming, whereby someone in Italy has listed an invisible statue. I'm not kidding, it was invisible. There's a picture of the artist showing on a plinth his invisible statue. He created an NFT on it. He sold it for $50,000. It was a wonderful tax fiddle for the Italian financial police, which apparently he got through. And it also worked very well for the insurance. It's amazing that you can make an claim for an invisible statue, having lost it. I think he forgot where he put it. But that is the nature of the world right now. The NFTs are still fraught. It's still an opening up market. We are looking at that marketplace. We have parallels with it, but we've done it as a top-down, verified, validated asset using systems and processes that we're all familiar with: search, survey, rule of law, transparency, adjudication in different jurisdictions, so that we can create an institutional grade product from day one on each and every one of our exchanges for each and every one of our assets. A simple pictorial aspect of this is, as you can see here, taking a property, dividing it up into squares. Each property title certificate is unique. It's registered on a blockchain, yes. We have two different chains, one for the title certificates themselves and all the information particular to that. So if you have a certificate, you can, on our exchanges, you can click through the symbol and go to the due diligence room, full search and survey, which our exchanges create and are audited by us. We have a specific process. The search and survey is done ostensibly by the exchanges. The vendor is able to sign off on it if they're happy. And then the property is listed like a company on a public regulated exchange as we go. We do anticipate on some of the numbers that each property that we would list on our exchange would increase in value between 3 and 6.5% without inflation on a like-for-like basis. We do anticipate the family offices and wealth offices that are working in our deal room structure and are providing the initial pre-IPO pathway and some of the, effectively what many people recognize as an underwriting type service as the properties go through that process and enter the retail board. We're anticipating that they should achieve about a 38 to 68% return on their capital on an annualized basis, because they can, every 6 weeks or so, they'd be able to move from one property going through that process to another property. So there's some good opportunity with the exposure in property throughout that period. Again, those figures without inflation. And it's designed both for the macro market and for the micro market. When we're having our discussions with the Bank of England and others, they love this for the monetary policy implications they can have for asset buying programs. It means that instead of putting enormous amounts of monies into companies that then buy their own shares, being cynical here for a second, they can actually buy fundamental assets in their own geography and use that as a process by which they can drive stimulus into anybody with a house or anybody with a property certificate. And they'd enter the market that place. But this time they get a physical asset, which is protected by the rules of their own country. So it's certainly very attractive. And the discussions we're having with the central banks is very much around the tools that we bring to them via our exchanges. If you look at the technology, I won't go into this in great detail, but we're very carefully designed using the AMMs, the mining technologies, the blockchains, wrapping, how we create that, how we use the AMMs to drive liquidity. It's worth making one marker here. These technologies allow us to ensure that any property that lands on our exchange and is listed on the public exchange is liquid from day one. Many exchanges have failed simply because they might be very good in many of their aspects of their provision, but in actual fact, they fail because they failed to achieve enough liquidity. The classic rule for any investor is, once you get into something, how the hell do I get out? It's not enough to invest in something. You have to have an exit path by which you can realize your investment. We provide that from day one. So when I highlighted that model of the cup of coffee, that liquidity exists for every property on every one of our exchanges from day one, because of the AMMs, because of the way those systems trade and work, and the way that we can work on the liquidity pools that exist within that world to provide that liquidity direct to property. But when I say that, effectively, it means there's always a price for any property certificate that you have in your wallet at any time. And that means that we can turn property into money. And that's a big change in the world. That's the formal part of my presentation. I'm here to answer any of your questions. There are different rules in France. I mean, we've had a number of people approach us to try to set up our exchanges in France. The issue a little bit exists in France relative to some other countries is that periodically the French have this habit of seizing property. And so you have to make sure that we can dovetail precisely with the French legal code, which is a little more difficult. I don't make any bones about it. When we're first deploying our exchanges, we're focused on the UK English Commonwealth legal system, because property rights are far stronger in that system than in France, individual property rights. So the ability to own property, hold property, and protect yourself to some degree from the state in holding that property is stronger under English common law than it is under French law. Having said that, we have a number of people who've been trying to set up the exchanges.
That's debatable from a French perspective.
Well, you might be able to argue that quite so far. We've taken some legal opinion as we go. We're not opposed to being in France. We're very keen to be there. Same as with other European countries that we're talking with at the moment. The issue for us is where do we deploy faster? And right now, following the path of English common law has worked well for us. There's some countries that'll be difficult. For example, Italy has very good property law, but their legal system takes about 18 years to settle a legal dispute. India has, again, enshrined on English common law when they originally set up on a lot of these systems. They have about a 30-year wait to settle a property dispute. So for us, we have to be careful where we launch to make sure that the property disputes and the adjudication that happens around them can happen quickly and efficiently around wherever we've deployed our exchanges, should there be any issues.
Let's speak slowly about France, only France.
Well, fair enough. We have to all have our biases on this one. Now that's kind of fun because that's rather interesting. This is where we're starting to address some of the social aspects of it. One of the key aspects that we recognize very early in the process when we're setting up our exchanges is that the property certificates that we create, the title certificates that we create, are far more valuable to the financial system than they are to the homeowner. For those who are deep in the economics of this, it's something which many people find upsetting. But if you realize what happens to your mortgage when you sign that mortgage document and take it to the bank effectively is a chop shop that chops it up into little pieces and creates pretty well overnight about 128% return on that. At least in the heyday in about 2008, a bit less, about 83% right now. That's information is very difficult to find, by the way. When you have that, what we're doing is we're cutting out all the middlemen. It means that you can chop up your own house into little pieces and take it directly to the market yourself via our platform, regulated, trusted, transparent, verified, validated, and they take it to the OTC market. And it means anybody with a phone now has that privilege. What we found is the institutions that we're working with are operating a 3 to 8 actually at the moment rate on the property certificates deposited on their account. To go back to Chris's question, though, if you wish to be more practical, the process is if you're a young person trying to buy a house, is ostensibly the house now is at about a 51% of its previous asking price with no obligation to pay the duties, costs, and mortgages on the 49%. So bottom line, the house that you saw yesterday that you coveted and couldn't afford, that if you can achieve a 51% purchase price of that property under our system, you can actually buy that property without having an obligation for the balance, which changes everything. We have different types of property certificates on the system. So the young owner, you can buy in a property at 51%. We have some of the real estate agents here in London are more than enthusiastic to offer half-price houses to the marketplace. We also have on the other side of the fence the opportunity for people who have mortgages to go mortgage-free. And we have lenders that are forming up on the exchange. They're very happy to buy out your mortgage obligation, at a premium, pay off the penalties, and see you mortgage-free, provided your LTV is below that 51% marker. So if you have a 40% mortgage, you theoretically can go mortgage-free on our exchange. I mean, if you look, the key thing when we set up the exchanges is we had to mirror the exact workflow processes that already exist for the conveyancing sale of properties. So, for example, if you wanted to list your property on our exchange, the first thing you do is you go to your real estate agent. That's the value chain. That's where they've always sat. And we don't want to disintermediate them. We want them to make more money off of us. And we've had our discussions with the big real estate agents, and they're very keen to find other ways that they can make money, particularly when there seems to be a dearth of supply of properties for sale in the London market, certainly. So they're very keen to be able to offer this because it is property and it's not regulated as such as a security. It means that someone who wishes to sell their house can come to them. They'll ask them whether they want to list it in the traditional way or whether they also want to list it in conjunction with that, like a joint marketing agreement directly on our exchanges. There's more value in listing our exchange. It allows them also, the real estate agent, to sell that go mortgage-free product, sell your 20% remaining of the value of your house that you have in your mortgage. It also allows them to do the traditional sale. After that, it goes into a search and a survey process, which is done by exchange-appointed surveyors and lawyers. The key thing is we wanted to take the conflict that quite often happens, particularly in the valuation process, out of the mix between buyer and seller. So fundamentally, the search and the survey is done under our auspices. We use the RICS Red Book in the United Kingdom. Well, actually, it's a template for all of our exchanges. We break down all of our assets when they're listed into their various rights, because you can have air rights, water rights, viewing rights in different countries, mining rights. And it is designed for all types of properties, ultimately, although we're focusing on residential at first, commercial, and then other types of properties. But you get full transparency on that. You click on a symbol on our trading screens or on the app that you saw a second ago. It allows you to see all that information, all the valuation information, all the search, all the survey, all the historic pricing. We have third-party feeds like Zoopla and others coming into the platform. So you get a very fair and open and immediately accessible access to that information. If someone wishes to generate more information and do further surveys, if they're buying a 300 million pound office building, then you might want to do more work. But that information is common. Once it's gone through that, it goes into a deal room process where price verification validation takes place. We like the traditional market metrics where somebody who's qualified to have an opinion which others can trust gets to go first. That's a very good idea from most of the market's point of view before it enters into some sort of an arbitrage or a trading system. So there's always a feeling that before it goes onto the main board, typically every property that lists has to sell a certain percentage of their property in the deal room structure for price verification before it goes on the main board. We're anticipating that everything that goes on the main board should have that 3, 4, 5% uplift, simply because that's the way the market is going right now in this high inflation environment. They're very hungry for assets. There's always that aspect to it. I mean, you get the usual health warnings, prices go up, prices go down. The one thing that this may sound counterintuitive, because property is such a fundamental asset to all of our economies and to all of us individually. Yes, it'll go on. In the high inflation environment, I would suggest it's highly likely it is bound to go up. At some point, it may go down, just like all markets occasionally go down or have their dips. We're in a high inflation environment. It may be a while before it does go down. But yes, it can go down, can go up. You get market information on this, and you can do your buy sell orders and your limits. So you can create triggers by which sales can take place automatically. So if you're comfortable trading within a bandwidth, that's fine. There'll be some who want to hold their stuff, HODLs. There'll be some who want to sell it, to trade it, arbitrage it. These are all what we've catered for on the exchange. So we have different types of accounts. We accept a lot of the retail investors will be using what we see, the app that you saw a second ago. They'll be using it to dabble. The threshold to get into this is literally pounds or euros, depending on where you're located. It's very easy to get involved, very easy to start trading, buying and selling property very easily on this, and then start to use it to pay for your drinks when you go out to lunch one day. These sort of things. These are all possible from day one when you open up the app. And people, I think, will increasingly start to use property instead of deposit accounts at banks, provided it's liquid and it's paying an interest rate that's higher than the banks pay. We actually anticipate that a lot of people would prefer to store their money, wealth, their accumulated wealth, time, that is their money, in a much safer asset than our banks can currently offer us. If you're in a high inflation environment, as I've indicated before, keeping your money in fiat is not a very good idea at the moment. If you can keep it in property and it's accruing in value while it's there, and the financial institutions are paying you a premium interest rate while it's there. If you look at the NFT world, they're paying 12.5% right now on deposits that are made with them in that world. We don't quite see it heading that level, but we certainly see a comfortable, in the current market, 5 to 8.5% on those deposit accounts effectively. It is different with us. I have to stress here for everybody in the room, you're actually buying the physical title itself, effectively under law, a physical slice of the property. This is not an asset-backed instrument. It's the title itself, and it's treated that way under law. I mean, there are three effectively different types of property certificates on our exchanges. One is the capital value property certificate, which ostensibly we've been talking about today. We have a rental share, and it's very carefully defined as rental share certificates, yield bearing. It's called rental share because it allows us to be Sharia compliant. And it means that you share on a monthly basis of the rental income of that property with whoever is the 51% holder manager of that property. So if you have student flats, you're sharing of that income. If you have a commercial property, you're sharing of that income. For the property developers, they love this because it means they have direct access to capital in the marketplace now, and they no longer have to go through the banks to get it. So I've never yet met a property developer who wasn't in need of cash flow or cash. We enable that for them. They can go direct to market now via our exchanges, provided their property is listed to the rules of the exchange, which demand utter transparency. We audit and check that. There's also reporting requirements, as you'd expect, like any company on an exchange. In this case, any property on their exchange has periodic reporting requirements. So they have to confirm, as you'd expect under any mortgage agreement, they haven't changed their property. They haven't taken down walls or et cetera, et cetera. If they wish to improve the value of the property, they can do so. They can do so if it's a residential owner, for example. You may want to upgrade your bathroom. That's your choice. As long as you're not changing the walls and the fundamental structure, go ahead. If you want to put an extra floor on, change the value, then you might want to exercise a preemption right that the 51% holder has to buy out the balance of the house. We've got financiers who want to lend money on that basis. And then you buy out the house, redevelop it, add the extra value to it, and put it back on the market. It relists again at a new value, and off it goes again. So we've enabled both sides of the equation here, both for the capital value asset, the rental share, the developers that sit within there, and inevitably, as suits our times, we have our green property certificates, which allow people to invest directly in conservation land or property that has easements on it. It still works within that, works exactly like the capital value certificate. It still has value. It might not appreciate as fast as others, but it still retains its value and can still be used in our world. Those property certificates, even though they might be in conservation land, can still be used to buy that cup of coffee. So for us, there's very little differentiation, but we are ostensibly, the headline is turning property into units of exchange, money. Yeah, we're born of the sharing economy, and we see two things happening right now. There's a breakdown of trust because our internet is not as secure as we were told it was. There's a fundamental distrust of authority because we're getting so much misinformation we can't tell what the real information is, and this disenchantment that's happening out the broader marketplace as some are getting extraordinarily wealthy and others are falling behind. And for all those who sit at the bottom or the middle income who are paying all their taxes, it can be disconcerting to see the concentration of wealth that's going on in this stimulus period right now, when they've put so much stimulus in, and the monetary inflation that effect has started to hit. And we truly do worry about, I must confess, because we're worried about our daughters' daughters sort of thing, our kids and their children, that we leave something better behind than we've got at the moment. We do anticipate, as we're seeing in microcosm in various countries, a greater and increasing disenchantment with the fiat debt-based economy. Our economies are saddled with way too much debt, which I think everybody can freely acknowledge can never be repaid. And so therefore, how do you manage that process in the future? If your debt is based in a particular currency and it can never be repaid and it continues to aggregate, our countries, and in many cases, people themselves, they're earning just to pay their debt off. They're not earning to live. And that's unsustainable in the long term. So there are systemic issues that are not being addressed in society. It's sort of the elephant in the room that people do not talk about. We do follow Ray Dalio. We're believing in the cycles, the 80-year cycles, 100-year cycles. We're due for one about now. Change is not necessarily a bad thing, provided you understand what's going on. And for us, if we can create something better out of the back of this, to address your question, that is part of our fundamental design. We're not here just to make money out of this. We're here actually to try to create something a bit better. That's a very good question. We've actually done this with the lawyers here. There's a 1925 Trust Act in the United Kingdom that allows us to do this. And the lovely thing is we don't need permission to do this because they've been doing it for almost 100 years now. So that Trust Act, we've had, it was a director of the former former director of Her Majesty's Land Registry, and the former chairman of the Mortgage Lenders Association in the United Kingdom, who currently is employed by the government to police bad banks. He's got some wonderful stories, by the way. Anyway, he's advised us. He's the go-to guy for the government generally when they look at acts of parliament. And in the legal opinion we've received, we're very certain on our ground on this, is that we have, to answer your question directly, we have the ability through that Trust Act 1925 to set up a structure which means that the legal ownership of the property certificates is very specific to the holder of that property certificate at the time. In terms of the land registry record, you get the owner of the property holding 51%. The owner of the property can still have a mortgage, that 51% can still have a mortgage within it. So there'll be whatever charge, lien, call within that side of that structure. But the 49ers, as we call them, the balance, they get represented by the trust that we've created.